Greetings traders and welcome back to another In-Depth with Chris guide. In today's discussion, we will be talking about the simple moving average. This is a very simple indicator to use, so those of you that like technical analysis based discussions, well, you're in for a treat because we will be covering a technical analysis based indicator. This is a tool that many traders use. It has been used for quite some time. We're going to cover all of the variables that go into calculating it, but more importantly, we're going to talk about some strategies that can be derived from using a simple moving average. After all of this, hopefully you will be more geared towards passing your Gauntlet Mini challenge. But before we go any further, let's go ahead and show you how you can apply it to your charts. That way you can follow along the entire time. If we're using the Finamark platform, we're going to go up to the top center portion of our screen, and we're going to click the Show Indicators Options button. Once we do this, we're going to click New Collection, and it will populate our available indicators that overlay price. What we're going to do then is we're going to scroll down to where we see Simple Moving Average. We're going to give that a click. And we're going to go back to our charts, and now we have a simple moving average applied to the charts. If we're interested in changing any of the settings, when we go to the right-hand column over here, if we click the cogwheel, we can change the color of the simple moving average or the period. But without further ado, let's get going. And if you haven't yet, please do me a favor and click that like and subscribe button down below so I can keep coming out with content for you guys. But here we go. As you browse the internet in search of more trading knowledge or trading strategies, you will almost certainly come across some type of SMA strategy, which stands for the simple moving average. This simple moving average is something that calculates the average of a selected range of prices, which usually is adhering to the closing prices by the number of periods in that range. As we mentioned at the beginning of our video, the SMA line can be adjusted by what is called the period. The period is going to be how many candles or how many periods are being averaged together to generate these plotted points, which then create the SMA that we are seeing across the chart here. We have a few different SMAs, which is why they're all not exactly in the same location. An SMA with a smaller period is averaging a smaller amount of data. It's a smaller amount of time, and as such, the line is going to more closely adhere to price. An SMA that is averaging a longer period of time is going to be a line that slightly looks a bit smoother, really, that is going to kind of work its way through price occasionally, but isn't going to follow it so directly. The shorter SMA periods are usually more preferable for shorter term trading because it's a faster reacting line, whereas the longer periods are generally going to be our preferred method when we're looking to trade longer term periods. Now, in the world of SMA, there are generally going to be 5-day SMAs or 5-period SMAs, 10-period SMAs, and 20-period SMAs. These are all extremely common, simple moving average period settings. On this chart, that's exactly what we have. The blue line represents the 5-period moving average. The purple line represents the 10-period moving average, and the green line, which is going to be the one that's kind of the smoothest with the least amount of jitters, is going to represent our largest period on this chart of the 20-period moving average. Once again, the preference, there is no right or wrong here. It's just a matter of which one is going to fit the current market conditions and my particular trading style. It's very common for traders to use a series of different periods. That way they have a faster reacting SMA as well as a longer term better indication of the overall trend in conjunction with it. On this chart, we can see a 50 period, a 100 period, and a 200 period SMA. So we can see how they are quite a lot different than the shorter periods that we just looked at on the previous chart. The 50 period here is going to be our blue line, the 100 is going to be our purple line, and the green line is going to represent our 200 period. This is going to be an example of when we were looking for maybe longer term trends that we would be interested in using using these much higher period SMAs because they are calculating such a larger amount of data, such a larger time span, that it'll give us a better depiction of the overall longer term activities versus those more intraday, day trading style activities that the 5, 15, or 20 periods might be providing us with. Let's take a moment to understand how the SMA works. Many external factors can impact short-term movement in investment markets, such as the E-mini S&P 500, which is one of my favorite futures markets. This could be a short-term political event, a disappointing employment figure that was released, or some type of just regular intraday volatility. Any type of unexpected development can cause the market to fluctuate. Many of these issues can be resolved or forgotten within a 24-hour period, so the key for traders is generally not to overreact to this if they're doing more long-term investing. So what is the best way that traders can achieve this, hypothetically anyway? Well, using averages of the prices over a specified period of time can help flatten the curve and reduce the impact of concise short-term price fluctuations that are occurring. This is why short-term traders prefer that 10 and 20 period moving average, while longer-term traders may use a 50, 100, or 200 period moving average. The key to short and medium and long-term investment success is to make sure that we're always on the side of the prevailing trend, and the SMA allows us to do just that. When we're using the SMA to give us a better indication of where the trend is going, whether it's the short-term trend using the shorter SMA settings, or it's the long-term trend using the larger SMA settings, it can provide us an edge over those that aren't aware of what this information might actually be. Let's talk about how the moving average is calculated, the simple moving average, that is. If we were to look at a 5-day moving average as an example and look at the different points that are plotted, and once the points are plotted and connected, we are generated with a line, let's talk about how those points are calculated. Let's say point 1, for example. That's going to happen when we add the closing prices from days 1 through 5 and divide by 5. That's going to give us our first plot point. Then for day 2, we're going to have, for our data point 2, not day 2, we're going to add our closing prices from day 2 to day 6 and then divide by 5, and that'll give us our second plotting point, which will connect 1 and 2. As we get to our third plotting point, we're going to add the closing prices from day 3 to day 7 and divide by 5. And as we go down this list, you'll see that this continues on in a very similar fashion. It's exactly the same. We just progressively continue forward one day. As you can see, day 1, day 2, day 3, day 4, day 5, day 6, day 7. And as we do this, we keep stepping forward with the days that we are calculating and plotting the points, and it gives us an average of all of those closing prices over the period of time being measured. Now let's talk about some simple moving average trading strategies. The first one to talk about will be the bullish crossover. And a bullish crossover occurs when the share price, or whatever it is that we're measuring, moves through the SMA into higher ground. As we can see over here on the left from our first shaded area, the indication of the market moving above our SMA lines could be considered a bullish crossover and an indication of bullish momentum to come. This is a very standard way to interpret what price is doing in relation to the SMA. As all of these lines that you see here are interchanging, the reason behind that is because some of these lines are going to be shorter term lines that are going to more quickly react to the bullish momentum. With the blue line here, you can see that it's a shorter term line because it immediately started working its way higher as price also started going higher, whereas the purple line was a little bit slower to react, followed by the green line, indicating the green line is our longest term SMA on the chart at the moment. These crossovers where price is going to go above or below the SMA is a very simple way to analyze if the market is potentially exhibiting bearish or bullish behavior in relation to how it's been behaving on average. When we start adding multiple SMAs to our line with different periods, the intersections of these lines, maybe it be a 5, 15, and 20, can give us a better insight into when we might actually want to jump into the market for that buy or sell. It kind of adds a further layer of confirmation and direction to where we exactly want to buy and sell, with the concept being, if the shorter line begins moving upward, we don't immediately buy as it follows price, which obviously at that point would be above it. But instead, we wait for the shorter line and all of the other lines to rotate. If all three lines, for example, right here, where they're going downwards with the highest period on top, the middle period in the middle, and the shortest period on bottom, when all of them rotate to the other scenario where the shortest period is on top, the middle is still in the middle, of course, but the longest period is on the bottom. When this happens, when all the lines make the flip, that can be an opportunity for us to go long and take advantage of some bullish momentum to follow. There's quite a few scenarios where we watched this happen from both directions. The same concept applies if the momentum was up and then all three of our lines flip downwards. Now, the periods that we use is going to be something that we're going to need to test with the market and the conditions that we're currently analyzing. But the idea and the concept is very simple. We're literally paying attention to faster and longer term interaction of moving averages and paying attention to how they're interacting with each other and using that information to then justify an entry to either go long or to go short. If they're flipping from bullish to bearish and have completely flipped their organizational factor there, where the blue and purple and green have flipped the order the other way around, well, then we can look for a sell opportunity in that case. Something else to consider is that SMA interaction with price or SMA interaction with other SMAs of different periods. Their interaction can also trigger exits from the market, not just entries. If hypothetically we were long right over here when the lines flipped bullishly, when we saw the lines flip bearishly, we could use this as our indication to close our position out because we anticipate some scary bearish momentum thereafter. So the justification for getting in can also be our justification for taking our profit and getting out. Trading with SMAs can provide some very clear-cut advantages, the main one being that it can flatten that short-term volatility and make sure that we're trading in the direction of the trend. The old adage for us traders is the trend is your friend, and that's because if we're trading in the direction of the prevailing trend, we're already giving ourselves a chance to go in the direction that's already happening, and therefore we should already theoretically be increasing our accuracy because we're not fighting the wave, we're not fighting the current. Instead, we're simply going in the direction that it's already going. Does that mean every trade that we place is going to be a winner? Absolutely not, because the market goes up and down in the short term. But if we're going in the direction of the prevailing market, then we're already giving ourselves a step up over those that are going against it. SMA trading has disadvantages as well, and they really resolve around the fact that if you don't have your SMA calibrated correctly, it might switch sides in relation to price or your other SMAs a little bit too early for the conditions that you're measuring, which is why we encourage using a bit of a practice run, making sure that you are adjusting your SMA lines and running backwards through recent price to make sure that they're responding in a way that had you been trading at that time, it would have proved profitable for you. If it is, then you've got your settings dialed in and you're ready to go. If not, then we should probably keep calibrating and work further, or work along the lines of adjusting those lines a little bit further. But until next time, folks, thank you for joining me as always. It's always a pleasure. I will see you soon. Happy trading, happy hunting, over and out. Bzz.